Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Welcome everyone to the Black and White Market Minute on Life Planning 101. We have Henry Knowles, Aaron, and Sam, and me, your host, Kade. How are y'all doing today?
Doing great.
Doing good. Happy birthday, Henry.
Thank you. He's a big birthday boy.
Yes.
Got a year older, and his KFS birthday was this time as well. So
yeah, so just hitting all the milestones, aren't you?
I'm going to start calling him a veteran.
He's managed to survive us for a year, so I guess that's there. Well, guys, what's going on?
Well, I was thinking earlier, there's several different ways or several different structures that we invest in. And my favorite way to do it is having separate stocks, just buying the stocks outright and having each of those companies through our quality growth portfolio. There's good and bad. It's really, really clean, not paying to hold anything, so it's a little bit cheaper. But the bad thing is, you get to see every company. You get to see what every company does. And there's a lot of psychological problems with that, because in any given year there's only going to be one or two companies that drive the rates of return for that portfolio. And I think it's about 10%. So 3 of our companies would drive the entire thing. Maybe a little bit less than half would be around market, a little bit less, a little bit more, but nothing to write home about. And then you're going to have some stinkers. I think it was Warren Buffett that said, in any given year, you should expect your stock to drop 70%. As a whole, the entire S&P, we're looking at 18% a year up and down. But when we're dealing with individual stocks, it's 70. You're talking way, way more volatile. And there's a saying out there, you want to buy low and sell high. But when you're really faced with it, it makes it a difficult decision. And, just seeing something red on your account makes you want to take action. And usually when you're taking action, it's out of fear, regret, all the negative things about investing in what makes it so hard. So I kind of wanted to do a little exercise today on the difference in buying stocks versus owning companies. How do you do it when you look at this ticker on your account and say, I am actually an owner of that company, and I need to be making decisions because I am a long-term investor and I want to be part of this company for the foreseeable future. And we got one of my favorites. It's been kicked in the absolute teeth. I hate it. I hate what the stock's done. It's been extremely painful, and I'm talking about Novo. Now, it is a fantastic company. It just lowered its revenue projections and its earning projection for the second time this year. They changed CEOs. They're just in a tough spot. And Novo is the leading company out there for the treatment of diabetes. And they were the first ones to come to the table with the semaglutide, Wegovy. Back in, I believe it was 22, the drug wasn't out there. Novo really wasn't prepared for how much they needed to manufacture. So our government came out and said, made it okay for companies like Hims or other small pharmacies, they could compound it. Make the drug themselves, the drug. Earlier this year, Novo came out and they bought some facilities. They're on track. They can make all they want to now. And government came out and said, hey, you have to stop compounding. But just like any other good attorney would take advantage of, they didn't say how. So if there's no clear orders, these companies are still compounding just as fast as they can. And it is hurting the company. Anytime you can get a generic, it's going to hurt with revenue. And it has. That's the main reason they've lowered guidance. And we're working through it now. But, so we've taken that pain, and I just want to talk a little bit about the math. Henry's with us. He's helped me out on this, so don't let me stumble through this. But we're trading at one of the lowest multiples that Novo has experienced in a long time. We're sitting at about $52 today. We were mid-40s a week and a half ago, so fantastic pricing. But if I was looking at this from an owner standpoint, so being an owner, I can pull the earnings out, any of the dividends or the distributions. I'm going to get that as the owner of the company. So looking at the dividend, looking at the earnings for the company, and for this figure here, I'm just taking what we've made so far in 25 and doubled it. But we can pay $52.32 and get a little bit north of $5 back for that every year. So look at that even as a CD. What is that payback? That's around 10%. Dividend was, $1.72? So if I had to look at it and I was starting day one, this would probably be my number one buy. And it's not even close. So if I could buy the company, and then as an owner, everything I get out of the company, I get that back. I should pay for myself in a little bit less than 10 years. 9.75 years, I will have gotten enough money back to pay for all of my investing. And you don't see that very often. If you have cheap companies, you don't have growth. That's one of the things that you give up. And Novo is actually punished, but they are still expecting 10 to 16% earnings growth, 8 to 12% on revenue growth. I mean, that is outstanding buying for a PE multiple of around 13. You just don't come across that. So I took the low end of that growth and I extrapolated that out for just owner's income, basic owner's income, like I said, dividend and earnings. And I got a return of about $85.50 over a 10-year period, $85.50. That's on a $52 stock. So that equaled out about 16.75%. As an owner, how would you feel making 16.34% a year? I mean, you don't come across these, and especially if you're saying, hey, I'm going to be as absolute conservative as I can be in all my projections. Fantastic company. So I wanted to just kind of compare that to Palantir. That is the stock darling right now. And if I would have to look at Palantir as a stock. I am putting it on black. This isn't a company that I can say I'm the owners and realistically give any kind of expectations. I thought this was pretty fun, but I took Palantir today. It's $177. I can get my earnings for the year about 45 cents. So right off the bat, would you rather pay $52.32 and get $5 a year, or pay $177 and get back 45 cents? I mean, that should be a no-brainer. But I know everybody's going to argue you have no idea about the growth. And I'm an owner. I've been an owner since they went public. Big believer in them. But if I put the same growth expectations as Novo, as a owner-owned company, it gets ridiculous. In order to get that, 16.34, in order to get the multiples to grow like Novo's, from 45 cents up to that PE, those earnings have to grow 90% a year for the next 10 years. 90. And you say, well, they can do it. They've grown 106% this year, grew 150% last year. So it's possible. But to put that in perspective, if they were able to do that for the next 10 years, Palantir would be a $247 trillion company.
Is that with a 13 PE?
Yes.
Yeah.
No, not the PE. Novo's PE, at their growth rate, it would have to, it'd have to grow 163%, the earnings. So in order for Palantir to do the same thing at their PE, so to grow that 45 cents up to a multiple of their share price,
Okay.
apples to apples there, 247 trillion, almost twice the size of all the wealth in the U.S. NVIDIA is sitting a little bit north of 4 right now, and this company would have to grow to 247. So looking at these two companies, Palantir's been awesome. And if you put $1 in there a couple of years ago, it's worth 18 today. You don't get to experience that kind of growth in life too much. It has been fantastic. But just to expect that to continue on forever or even the next 10 years, it's mind-boggling. So I know, like I said, if we're buying the individual companies as a stock portfolio, a lot of times that we look at those and say, get out of the bad ones, get out of the bad ones. But it's not always that easy of a decision. I definitely have a lot of regret, and one of the things we try to fight off is our different biases. And when we look at Novo, I absolutely have a lot of regret. And I ask myself if I'm experiencing loss aversion. So basically looking at this company and not wanting to admit I made a mistake. I did make a mistake, but holding on to it because of that fear. I sure hope, I don't think I'm doing that. We've put so much work into this company on whether we should get in, get out and start clean or ride with it. I don't know what y'all's belief is, but this is one of those companies at this time that I think it's kind of hard to mess up.
I think it goes back to one of those points when you look at those, when you're at a loss, and it's a really big, it depends on how you look at it. Because like you said, there's two ways to look at it. Is you can think, oh, it's at a loss, but I haven't sold it yet. So that's not real yet. It can still bounce back. I can make it back. And that's what we call in the psychology world anchoring. You're anchored to what you bought it for. And so if you can't get that or more, we don't do anything with it. But then you have what you were talking about, that loss aversion, the sunk cost, where it's at a loss and it's you're thinking, oh my gosh, I could lose more. I need to get out of it right now. And that's what most people, when they look at the stock market, they see. Like you were talking about at the beginning, we have those red lines, we hit it, and we see those and we freak out. And it's finding a good balance, like you said, and doing that kind of, okay, where's the world at? What's the stock doing? Doing a little bit more deeper dive into it, I would say, to figure out if it is going to be that let's hold and see what it does, or a hey, it may not be getting better in that way.
Amen. And we're kind of in the same situation with Hershey's. Hershey's, it's had a pretty good year, but it has been beat up because their largest cost is the price of cocoa. And COVID, it got out of this world expensive. And it's dropped a little bit, and we've been looking at it, and that one was probably a lot of anchoring. I was looking at that company and I had kind of the farmer or the rancher's mentality of, if we didn't have rain last year, we're going to get it this year and everything's going to get back to normal. We've been down some pretty deep rabbit holes on cocoa, the trees, all the new production coming online for cocoa. But that one I'm about ready to give up on. Not to say it's a bad company. It is a fantastic company, but we're looking at cocoa prices to finally get back to normal in 2026, somewhere around in there. So that one I'm ready to cut my losses, admit what I did wrong. But Novo, that one's a tough one. falling in love with it
I
all
think,
over again.
yeah, looking at it, it almost sounds like instead of looking at sunk cost or any of that, you've just gained an emotional attachment to it. You're falling for it.
We gotta worry about that for sure.
Yeah, and that's the hard part is you can put it all on. It's funny, y'all can't see it, listeners, but they all have their pieces of paper, and I don't have any paper, so I'm just kind of going off of what I'm saying. But you can do all the math and statistics you want on whether or not to buy a stock or sell a stock, but then you get into kind of like what Aaron's talking about, that emotional piece of it that you can't put on a piece of paper, and that changes the conversation drastically on what you want to do.
Yes.
So the way that I would look at Novo, and we're comparing Novo and Palantir, if you're going to purchase a business, do you want to purchase it for a good price, or do you want to purchase it with a lot of hopes? So Palantir's current price to earnings ratios between 5 and 600. So if you were going to have $1 of earnings, how long? I mean, that's if there's no growth in it, that's hundreds of years before you get your money back. If you buy Novo, your margin of safety is, I mean, you can't compare it with Palantir. If Palantir's growth changes by 0.5%, it's going to readjust so much of their valuation. If they don't meet growth for 1 quarter by 0.5%, the price adjustment that you could experience there is going to be not comparable to what would happen if Novo's pricing is so good compared to Palantir. I mean, if they miss earnings a little bit, you're going to have some price movement, but they're not changing out and extrapolating aggressive growth rates for the next 10 years to justify today's prices. Yeah. They have assets. They've got different true assets. I mean, if you wanted to turn around and liquidate the company today, they would be able to do that for, I'm not going to say it's at liquidation value right now, yeah. but creditors would be paid off. If you tried to sell Palantir as a standalone company at a 600 PE, I mean, I don't know that anybody, it's disconnected to a degree unless everything's executed perfectly or even better.
Yeah, just think about this. Palantir could grow its earnings 100%. 100%. And that's pretty good, right? And the PE dropped to 100. Your stock would go from 177 down to $90. And that's on a double. In earnings, we talk about this, it's a popularity contest. It is something that we're willing to pay for a company's earnings. It's not set in stone, and not at all. And it changes on a whim. It's just what kind of mood is the market in today, and it could be firing on all cylinders and not work out.
Well, and not only that, it could also just depend on your mood too.
Yes.
You know, I mean, I could wake up one day and think I'm going to buy all the Novo, and then the next day I had that buyer's remorse of, oh my gosh, what did I just buy? And so I think there's a good balance with that as well.
Yes. Yeah, just back of the napkin stuff. Palantir could quadruple their earnings. I mean, grow at 200%, and the PE dropped to 100, and the stock would not change. That is insane to think about. Now, it is one fantastic stock. Very, very exciting company.
I've got some stuff here. I'm going to read it real quick. So just some effectiveness of Palantir on some of its clients. So Heineken accomplished a supply chain transformation in 3 months that was originally projected to take 3 years using Palantir. They cut it down. AIG expects to double its 5-year growth rate from 10 to 20% through AI-driven underwriting capabilities. And then BP saved $1 billion with a B using Palantir's digital technology. United Airlines prevented 300 flight delays and 20 cancellations through predictive analytics using Palantir's technology. So the excitement, you fall in love with something.
Yes.
And it's no price is too much is the thought process. And whenever you see statistics and numbers and please customers to $1 billion, it's almost, how do you price that feeling of somebody saved you $1 billion?
It is a fantastic company. And you forgot, how come Russia did not just mop the floor with Ukraine? Palantir. That was, other than our weapons, that was probably the biggest advantage that they have. And if they can do that, what else? But can they keep doing this? 10 more years. We own it, so hope so.
Well, and that's almost what it takes is 10 years to justify today's price. So the next 10 years have to go, and maybe not a complete 10 years, but the future has to be without a bump. There
Yes.
can't be any interest rate negative effects on it. They can't have any. There can't be any kind of a banking, even a semi-crisis on banking that might be associated with it. There cannot be a glitch, or else it's going to be a repricing for Palantir that might turn it into more an exciting opportunity to buy.
It could get very painful. So going back just apples to apples, what is the better investment today? If you had the magic cards, you had all the money in the world, which one would be a safer, more sure bet to go out and buy Novo at today's prices, or throw it on Palantir?
Novo, you have your that margin of safety, like Graham and Buffett always talk about.
Yes. And, this is such an exciting market right now. Novo's not the only one out there that has these kind of discrepancies in price. And, there's going to be companies that do it every single year. That's just a head scratcher. And it seems right now that there are a lot of companies that are beat up. And the market as a whole is just so focused on AI and what kind of world-changing things that technology can do for us. And it looks like we're missing out on some fantastic opportunities.
Yeah, I did want to add on to that. Aaron, you did mention earlier how Warren Buffett said with individual stocks you can expect around a 70% drawdown. Well, actually, Novo, as of last week at 45 a share, experienced that 70% drawdown. But yeah, I have a few just fun facts about Novo that get me excited about investing in this company. And yeah, so in general, the healthcare sector, I know Novo is not a U.S. company, but healthcare sector worldwide has been down this year. In the U.S., we're down 5% year to date versus the S&P, which is up 9%, I believe.
It's been a rough spot everywhere.
Yeah, and
not everywhere, but everywhere in the pharmaceutical industry.
So, just looking at the stock price, if you were to buy Novo today at $51.52 a share, you're basically buying at the exact same price as you were in 2021 before all of the weight loss drugs came out.
Yes.
Which is just remarkable. You look at compare the revenue and net income compared to the stock chart. It's just flipped upside down, which I believe is just an opportunity. And
it's still growing.
Yeah, company's still growing, double digits. This is a legacy company. I think it's been around over 100 years. Novo has, and just on the oversold, just look at the technicals. We have never been as this much oversold on the monthly chart than now compared to 1987. So I think it's a no-brainer.
Yeah.
Well, if you're looking at it from a price performance standpoint, you see a company that's doing poorly from just strictly price performance. You're probably gut reaction, unless you're my gut reaction is to take a deeper look, but beforehand, the gut reaction is to dismiss it and assume that this is going to continue. And the same thing, if a company's going up, you might not buy it because you think you're going to get a better entry point here or there, and then it continues to go past where you thought it would, and then you buy it, and you bought it at a bad price, and then you start getting flat or pretty much flat or negative performance. The momentum of the price, one way or the other, is a huge effect on you mentally on when you want to buy it and when you don't. So,
that is the reason why the average investor makes about 2%. It's because we can't get out of the way of our own mind. And to kind of pile on what Henry was saying, Novo does have some really, really tough competition with Eli Lilly. and that has recently just flip-flopped over about the last week. Lilly came out, and their oral drug didn't do quite as good as they thought it would. Very, very similar results as Novo's oral. So, Novo's had a good 16 to 20% bounce off the bottom, while Lilly keeps dropping. So instead of this being this clear-cut winner, the market's starting to say, "Whoa, maybe we need to look a little deeper at this. Maybe we got this wrong." So very interesting space. Takes up a lot of real estate in my head right now. Fun stuff.
I think a really big catalyst could be. I was just reading what analysts were saying, just a few articles yesterday on Novo. From what I've heard and what people are saying is that Novo's oral Wegovy pill is ahead of where Lilly is, like you just said, and then I believe Novo's waiting on a decision by the FDA in the fourth quarter of this year. So if that gets approved, that's a catalyst right there that just turns this thing around quick.
This is one of the silly things about this. Lilly and Novo did the same exact thing, where they put out their oral, and I'm just going to be exaggerating on these figures, but they tried to get a 10 milligram drug passed. And when the testing got through, they said, well, you only lost about 13%. And then Novo came back and said, well, that's not actually the dosage we would use. We would use 50. And these are exaggerated numbers, but it was huge multiples of what they were going to do for the need. And Lilly just did the same exact thing. Yeah, for this small amount of drug, it did 13%, and market just vomited all over them. It's difficult to watch people make the same mistake over and over again. It's just, that stuff it cracks me up.
Talking about picking up cheap healthcare companies, I mean, UNH has dropped 50% since April, and then you had a couple of value managers, Buffett and then Michael Burry, pick up shares. I mean, it's kind of comparable. You have a company get its price cut in half, and then the disciplined, I don't want to call them bottom feeders, but that's essentially what they are. They go out and they find undervalued companies and pick them up, and I think Novo fits that glove.
Yes. Once you get to the point of saying, hey, I don't think it can get any worse than this, and you have the courage to step in and take advantage of it, those are the times that make an investment career. Cool thing is Buffett's done it several times.
Well, and that's really it, is when you see those bottom numbers, like you were saying, it's either you look at it as kind of what Sam was saying, you look at it as a loss. Just, I don't want to get into that because it's going to go lower, or you look at it as opportunity.
Yeah.
I'm going to put in and it's going to shoot back up. So I think that's kind of what all of you have been saying this whole time, is just kind of taking that chance for it to do that for you.
This year has been so interesting. I wanted to start an actual value fund and be able to pick up companies like this and go with it. I haven't seen this kind of market in a long time, and it is so interesting. It's a fun time to be alive.
Yeah, Kate, just to go back to what you just said. So, yeah, you pick up those companies that are down and beat up, but the idea behind picking up those companies at discounted prices, or at least the way that you should think about it, is I can't wait for this price to pop, but instead I can't believe I'm getting next year's earnings at this cheap of a rate.
Yes.
And so you got to think about those cash flows, the company, what used to be a balance sheet, now it's all software, intangibles, or how can I save $1 billion using today's technology to make next year even better? So it's all about the fundamentals of the business, what is at the end of the cash flow statement at the end of each year, and how expensive is that for me today?
Yeah, amen.
And
That's kind of where I was wanting to go with this. Look at this as the owner of the company and not a stock on your Schwab statement.
Right, we look at things as humans. We look at it very much in today's. We don't look past today's vision, or we look at yesterday. We don't ever look in the future. And to Sam's point, if I'm understanding correctly, it's that you look at this number. Yeah, that's the number today, but you're buying in the future of it. You're buying in those future earnings. And so the idea is, wow, like you said, wow, I'm getting it for this cheap price for my tomorrow dollar.
Yeah.
Did anybody even look to see what the market did today?
That is y'all's
week-
job. I don't
I
do
usually
that
pull
much.
up the exact numbers.
Yeah, I can pull them. I mean, I think the market's been kind of odd this week. I know yesterday it was down, I believe. Let me see. Over the past week, we're up 1%, but today we're
It's-
slightly down.
There hasn't been a lot of change in the market. It's been a lot of push and pull. We did get the PPI numbers out, and those were, headline risk. Headline, it looks like it was bad. Inflation was peeking its head. But when you start digging into it, it really didn't do anything. Pricing, diesel prices went up. Nothing looked bad at all there. There's something big going on in Alaska, so there might be an opportunity to stop the Ukraine war. Pauses on tariffs, adding more tariffs. It's just a normal week.
Normal Trump week.
Normal Trump week, yes. So still studying, still looking at everything, but there wasn't a whole lot to raise eyebrows this week.
I know that I have some reading to do. We have some earnings statistics that I was hoping to have ready for today's podcast, but that's going to have to wait till next week. I have some facts from FactSet that came out. Earnings are looking good for the year and everything. I just don't have those numbers in front of me, so next week we'll dig into that some maybe.
And I would like to do a little bit of research. We've been doing this podcast for a long time, and every quarter earnings are up 8%, revenue's up 12%. We're beating 70% of all of that, over and over and over again. And when does that change? I mean, even when we've had really, really bad markets, it's still 54% of the companies are beating their earnings. Our economy and our market of companies is just absolutely amazing when you think about it. And the opportunity going forward is huge. As long as we can have the right mindset and we can keep the discipline, there's a bright future for everybody. It's just the day-to-day that's scary.
I can't wait to have a AI robot in my home folding my laundry and cooking my food.
Probably very soon.
Yeah.
It's not too far off.
2040, 2050.
Oh, gosh.
I guess we can conclude. Happy birthday, Henry.
Thank you.
Happy birthday. Hey, everybody, have a great week, and God bless.
God bless. That's going to be another episode of the Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.